Welcome to Cup of Joe for June 3rd, 2021. My name is Jason Pounders. I am the marketing manager for Ryerson. I am filling in for Mike today, who is on vacation, but glad you could join us. And again today with the man of the hour, Nick Webb, our director of risk management and commodity hedging for Ryerson. Welcome, Nick.
Hey, thank you very much, Jason. How you doing today?
Doing well, doing well. Beautiful day in Chicago.
Oh, it's lovely.
Summer is here.
Fun fact for those out there, Jason actually lives right outside my window. You can't see because it's actually too bright, but if you can see a building out there, that is where Jason lives. So he could zip line down here. We could just do this presentation together. But
we are that close. We are for sure. All right, so I know you got a action-packed session for us today. Why don't you jump right in and update?
Yeah. It's funny. 2 days ago I was talking to our head of supply chain, my boss, and he was like, "What are you going to talk about this month?" And I was like, "I don't know. It seems like not much has changed." And I started putting together the slides, and I realized there's plenty to talk about. There's a ton to talk about. We're going to spend, I would say, the vast majority of time, similar to last month, on the macro side of things, because again, similar to last month, it tends to be all sort of rising tide lifts all boats, or vice versa, where all of it's really centered around this macro theme that is reopening, COVID, bottlenecks, things like that. And they all tend to be pretty well correlated with one another. There are some pockets of differentials between different commodities, but for the most part, they're all generally trending the same. But we've got some new charts to talk through, some new data points to talk through, definitely some things to ponder within the slides, but we'll go ahead and hop into those right now. And I know that in prior presentations, I didn't maximize my screen, so I apologize in advance if those charts were a little small. But before we hop into the presentation, we got to cover the safe harbor provision. The legal eagles are going to love that I do this each time. This is not investment advice. These are Nick Webb's personal opinions. They aren't the views of Ryerson. Do your own research, those sorts of things. We're going to give you what we think are the most pertinent items going on in the marketplace, at least in the views of myself. And hopefully we can get some good Q&A going at the end of this as well. Some of these slides are going to look somewhat similar. This one in particular, it's a big one, but it's generally trending the same way that we've been going the last several months. We've kind of dropped off a lot of the really, really ugly COVID data over on the left-hand side. You still got little sprinkles of it, as you can see, some of those red marks. But as we roll through time, you can see that very clearly from a demand perspective, from a manufacturing PMI perspective. Demand data looks quite strong. Within the United States, we just got the most recent manufacturing data. That came in at 62.1. It really doesn't matter what region of the world you're looking at. Most of them are running, mid 50s, some in the low 60s. The exceptions of that are going to be India. No surprise. They've had their bouts of COVID over the last 45 to 60 days. And then Turkey's actually having a tough time of it these days, both for, general economic reasons, but also pretty heavy, I would call it hyperinflation, where their currency is kind of collapsing right now. So their economy is struggling fairly hard right now. And then for whatever reason, Mexico continues to have a tough time of it. And that's been the case for the better part of the year at this point. But generally speaking, demand is quite good, continues to be the same. So we'll go ahead and breeze through this slide here. I've tweaked the slides ever so slightly to now call it the shortage of almost everything. And we'll get into why I've added that caveat, because there are some small things that have changed over the last 30 days, where if we looked at a lot of these charts, if you remember back, many of them were just straight parabolic up with no end in sight. It actually feels like in some of these markets, we're starting to see pockets of an end in sight. It's early days. I think we're in a transitionary period right now. But even, if you get out your microscope, you can almost see it slightly within the industrial metals index as well. So this is going to be the Bloomberg Commodities Metals Subindex. So this is just a basket of metals indexes. It's at 5-year highs, obviously, but ever so slightly, you can see we're starting to get a little bit of choppiness, a little bit of volatility. I think we're starting to see a little bit of profit taking and potentially some jitteriness within the industrial metals space. And we'll dive into a lot of these charts in more detail, specifically with regards to the metals. But we'll also talk more broadly on many other industries outside of just industrial metals, because they're all generally correlated. They're all generally following similar themes. We touched on all four of these pictures, these charts last month. And as I mentioned, if we went back 30 days, every single one of them was a knife edge up, straight parabolic to the moon, no end in sight. But here we are fast forwarding just 30 days, and already you can start to see the flatbed truck index, again, ever so slightly starting to pull back a little bit. Lumber prices, even though that doesn't look like much of a pullback, that peaked out at $1,700, and we're now down around $1,250 to $1,300. So you're talking about a 25% move over the course of a month. Similar with corn prices. Even in the case of semiconductors, while it's not pervasive across all automotive companies, we have in the last week gotten word that GM is looking to open 5 of their facilities because they believe that they've gotten the semiconductor issue under control. Now, that's not true across all automotive OEMs. Seeing headlines just in the last couple of days that Tesla is having some gripes about other automotive companies potentially double booking, double buying, things like that. So it sounds like some of these other companies are still having some issues, but there are small signs that things are loosening up a little bit. And with that, you're getting kind of the backside of these parabolic moves, which, the corrections can be somewhat swift because what goes up must come down in a lot of these cyclical industries. And I apologize in advance if you hear a little bit of background noise. My dog just got out of bed and found the hardest bone to chew on right now. So apologies for that if you hear that. We talked about this chart or these charts last month, and I did not realize how front and center this was ultimately going to be. Just either a day or a couple days after we presented on these slides, we got the unemployment data, and it scared the bejesus out of the entire marketplace because all of a sudden everybody said, "Uh-oh, unemployment rates aren't improving. We need to do something about getting these workers back to work." And for about a week or 2 weeks, that was basically the top economic story. And little did we know when we were presenting this on Cup of Joe that it was a relatively little talked about topic, is now pretty front and center within the reopening trade, the inflation trade. Unfortunately, we don't have the latest data point to either one of these charts. The next data point's actually coming out tomorrow, Friday. So I would recommend anybody who's on this call, anybody who's listening to this presentation subsequent, Friday morning, we are going to get the latest jobs numbers. If I was a betting man, I think we're going to see some pretty swift moves higher in both of these, which is going to suggest that people are coming off the sidelines and getting back into work. Now, why would that be the case? One, as we mentioned last month, I don't think the reason why employees are on the sidelines was for any reason because of lack of demand. I think there's plenty of demand for skilled labor, whether it's high school educated, whether it's college educated, doesn't matter. There is demand for workers, both within Ryerson and externally, but particularly within the manufacturing workspace or landscape. It certainly seems as though there are severe issues with getting workers back to work. Now, what's happened in the last 30 days? Well, about 15 to 20 states have rescinded their extra unemployment benefits, which what that's trying to do is stimulate the idea of saying, let's light a fire under their butt, let's get them back into work by pulling the rug out from under them, basically. I think that's ultimately going to help improve these numbers. Secondarily, I think you're actually seeing corporations truly offer more incentives to get people back to work, whether it's by way of actual payments or if it's by way of incentives. A couple examples would be, just in the last 2 weeks, McDonald's announced that for new hires, they're going to be giving away free iPhones. So that's, call it $1,000 to $1,200 essentially sign-on bonus by way of an iPhone. Similarly, Walmart announced today that they're going to be giving 750,000 employees, 750,000 associates, they're going to be offering a free Samsung phone. So we're certainly seeing these incentive structures occur. This is absolutely a front and center topic to get us back to where I think we need to be to have a free-flowing, efficient labor market. And I think we're going to get there over the course of the summer. So, if we were to predict what these charts look like tomorrow, I think we're going to see pretty swift moves higher. And we'll ultimately revisit these charts in subsequent Cup of Joes. But I think this is going to be one very pivotal step in getting a lot of these bottlenecks and the shortage of quote unquote almost everything back to normal to some degree. Now, we touched on this chart last month. We've got a more recent data point. This is the Chinese credit impulse chart. So ultimately, that's a fancy way of saying how much, how accommodative or how loose are lending standards within China. We talked about the fact that over the last few cycles, they've tended to be big money in, big money out. It looks like this trend is no different. If anything, it may even be more swift to the downside in how quickly they're trying to contract their economy and bring in risk-taking, cool off bubbles, things like that. Why is this relevant? This is relevant because this data tends to be correlated to the price of commodities with some sort of lag factor. We'll call that lag factor 9 to 12 months. Generally speaking, if you're seeing Chinese demand or Chinese speculative activity cooling down, China makes up a large percentage of the world's demand for metals. And if they're demanding less metals, then ultimately that's going to feed through to a lower price at some point in time. So it's not, the light at the end of the tunnel isn't a month away, but it's certainly something that looks like we should expect come early 2022, I would say. Again, we'll continue to watch this data and see how this trend plays out. If it continues to go the course of the last two trends, I think it's just going to become more and more set in stone as we roll through time. This is a new chart for this presentation, but this is one that I think it's pretty fascinating, and a number of hedge funds that I like to follow do watch this chart. It's a little complicated, so I'll try and give kind of a layman's term explanation as to what we're looking at. The blue line is going to be what's called the copper gold ratio, and that's no fancier than just taking the price of copper and dividing it by the price of gold. Now, why would you want to do that? Why is that even something that anybody would want to do? Well, if you think about what copper is, copper tends to be used in manufacturing activities. It's used very heavy in electronics. It's used in the electric grid for infrastructure. It tends to be more of a risk-on type metal. Whereas gold tends to be a place where you put your money when you're scared to death, when you want to go risk off. You tend to put money back in US dollars. You tend to put money back in gold, safe haven assets, if you will. This index is basically a gauge of how risk averse or how risky the market is at this point in time. I would argue that with copper essentially outpacing the price of gold, it's basically saying that the market is willing to take a lot of risk right now. Overlaying that chart is the 10-year yield. So this is going to be the 10-year treasury rate. So that's interest rates. Interest rates over the last 12 months have been exceedingly low, the lowest levels in the history of the United States, and rightfully so. We went through global lockdowns. We went through some of the most, whether artificial or not, the most artificially difficult financial conditions in the last 100 years. And for that, the Federal Reserve and the Treasury decided that they were going to take interest rates as low as they could. But here we are in an environment now where people are getting back to work. People are getting back to making things. And obviously, ISM services data is at the highest level in history. So risk is back on. But interest rates really haven't fully adjusted. And when you look at this chart, there tends to be a fairly tight correlation between the copper gold ratio, i.e. how much risk is in the market or how risky people are willing to be in the market, and where interest rates ultimately may or should be. If we use this chart as a gauge, if we believe this chart should hold up and this relationship should hold up, I would argue that one of two things either needs to happen. Either copper prices need to revert back lower, or more likely, in my opinion, I think over the course of the next 3 or 6 months, we're going to see interest rates move back higher. Why would that be the case? Well, a lot of what's going on in the market, whether it's copper prices, aluminum prices, steel prices, lumber, semiconductors, there's a shortage of everything, and prices are near record highs in a lot of different instances. I know that the Fed is ultimately saying that it's transitory, that it's temporary right now, but I think every day we roll through time, it's looking more and more like this isn't transitory, that it isn't temporary. And now we're starting to see it even feed into wage data with all these incentives that are occurring. The more and more instances of this we see happening, I think the more likely it is the Fed's not going to have any leg to stand on to say we don't hike interest rates. So My gut feel is we continue to see the 10-year yields head up into the 2 range, with a 2 handle. Does it get to 250? I don't know, but I think this is certainly going to be one element that's going to help cool off the market a little bit, potentially bring down prices, potentially loosen up markets a little bit. We're not seeing it just yet, and the Fed has been very vocal and very adamant about the idea that they don't yet want to do anything because they don't yet think we're through all this. But again, every day we roll through time, it's looking more and more like there's a concerted, inflationary story going on that probably needs to be addressed.
Hey, talk about, we got a lot of friends in the oil and gas market, and talk a little bit about that. We've had a kind of a sharp increase in gas prices that obviously impacts transportation costs. Talk a little bit about oil and gas and what you're seeing there.
Yeah, absolutely. And I think, I'm really glad you asked that, because I do think that, whether or not we like fossil fuels or not, whether or not we want to be green or not, I think it's hard to argue with the idea that in the last couple of years, fossil fuels have been kind of given the scarlet letter. They're sort of a 4-letter word right now. And ultimately, the amount of investment that's shifted into things like clean energy, recycling, other alternative sources of energy might end up being, at least in the short term, a little bit of an issue with regards to causing shortages within fossil fuels, and more specifically within crude oil. What do I mean by that? I think there's a growing chance that as we roll through summer, we may, and when I say may, I put maybe 30 to 40% odds on something like this happening, but there's a chance that for a couple different reasons, which I'll get into here in a minute, we could see crude oil prices and fossil fuels in general join the inflationary party, and potentially, who knows, head towards record highs, the way we've seen in other commodities. Again, I know that this isn't something that's widespread or widely believed, but I think it's an outside possibility. We've already seen a pretty decent sized recovery in the price of crude oil. If we were around to a year ago, we would have seen crude oil down around $20 a barrel. We're now at 60 to $70 a barrel here in the West Texas Intermediate market. But I think we're getting into a potential scenario, and it's getting a little tricky, whereby you've got a couple elements going on. One is from the demand side, we've got jet fuel demand coming back at a very strong clip, and that's even before business travel is coming back. So you look at TSA checkpoint data, some of the recent data is suggesting about 1.9 million passengers per day. To put that into perspective, that compares to about 2 to 2.5 pre-COVID for where travel would have been at that point in time. We're pretty darn close to that, and we're not even back to anywhere near the full swing of things with regards to business travel. So I think that is outpacing the expectations on the demand side. I think additionally on the demand side, we're heading into the summer months. Obviously, a lot of vacations, a lot of travel by way of vehicles. I also think that a lot of people who are commuting into the work, maybe at least within cities, maybe aren't doing so by way of mass transit. They're going by way of their own individual vehicle, which is going to increase the demand for things like gasoline. Factor into that 2 additional factors, which is one, on the supply side, OPEC has been pretty vocal in saying that they want to be slow in bringing production back online throughout the course of the summer. It's almost like they want to see demand outpace supply to a degree. And if that sounds familiar, it should. This idea of demand outpacing supply. I'm not here to say that we don't have enough supply globally to supply this marketplace. What I'm saying is, I think there's a growing chance that we might see a mismatch between the pace at which demand comes back online and the pace at which supply responds to it. And it looks like it's almost purposeful within the OPEC world. Sprinkle into that, over the last week, we've seen an Iranian oil refinery catch on fire, and coincidentally, or maybe not so coincidentally, the largest Iranian military ship also caught on fire and sank. So there could be some turbulence going on within the Middle East that might, sprinkle in some additional volatility or maybe upside within the fossil fuel market. And then the last one is really just this notion that, the longer we continue to treat fossil fuels like a 4-letter word, the less investment that goes into the production of new assets or the investment into new assets. It almost creates a self-fulfilling prophecy, whereby if more and more assets are staying offline because they don't view it as something that's socially responsible, which that's a completely different debate, but it could actually further and exacerbate those moves to the upside. So not necessarily prediction, but I think it's at least a risk that we should keep our eye on, because you're getting a little bit of a, not necessarily a perfect storm, but you're definitely seeing some things line up. And crude oil, admittedly, up until this point, really has been like the one commodity worldwide that hasn't really joined the party to the upside, to the upside to record highs. Could we see $120 oil? Maybe for a short period of time, maybe. So I think it's certainly something we want to keep an eye on. But as we think about inflation, if we start to see crude oil go to $80 or $100 or $120, I think it reverts back to Washington, D.C., and it just gives them less and less of a leg to stand on to say we can't hike interest rates. Because if crude oil joins the party and gasoline's going to $5 a gallon, you're going to see a lot of complaining at the pump and with food prices and pretty much everything else out there. So yeah, I appreciate the question. I think it's certainly one that I think some analysts are watching, but it's not getting a ton of traction just yet, just because I think most analysts would say we've got plenty of production capacity to fit demand right now. But I would say the same thing within steel, and we've got record high prices. Steel isn't at record high prices because we don't have enough steel production assets out in the world. We've got plenty for it. It's just there's a mismatch for right now.
You heard it here first.
Exactly. This is the last slide on the macro side, but this is one that I really want to address, and I'm afraid I'm not going to give you an answer on what's going to come out of it because I don't know how it's going to play out. But I was surprised enough by looking at these charts that I wanted to at least include it because I think it's a really good debate. I think it's a really good thing for all of our customers and even our employees within Ryerson to contemplate. First, what are we looking at? Well, these are two different charts kind of showing the same thing within two industries, but it's the University of Michigan Consumer Confidence Sentiment Survey. So this is a survey that goes out to hundreds, if not thousands of individuals who may be in the market to try and buy a car or buy a house. And all it's doing is saying, how are you feeling about the process of doing so? Are you feeling good about buying a home or are you feeling bad about buying a home? And if anybody out in the cybersphere has been in either of these markets, you will know that both of them are running extremely hot. So I was actually kind of surprised to see this data look so ugly. But I think when we take a step back and we say, why would the data be so ugly in both of these instances if these markets are running so strong? Well, if you consider yourself as a consumer of either of these products, it's almost impossible to get a home right now unless you're willing to bring cash to market, pay above an offer. It's extremely difficult. I would imagine, I'm not in that space right now, but I would imagine it's extremely frustrating. And I think, it's a little bit of a two-sided coin because the person who posted these, his name's Dave Rosenberg of Rosenberg Research. His take was that this is extremely bad news for commodity prices. That was his take. I kind of look at it in a slightly different perspective because he was saying that he thinks this is going to blow up demand. I tend to look at it in the current context of saying, well, the reason why buyers would be so frustrated right now isn't necessarily because they don't want product. It's because they just can't get it. There's almost too much interest for product, which that to me almost has a bias to the bullish case side, that things are almost running so good, so well, that it's just really hard to outbid the competition to get that next incremental product. Now, here's where I play both sides of this coin, and I do kind of pose it back out to the audience, and I think it's a good thing to contemplate, is whether we're talking about cars, whether we're talking about homes, whether we're talking about steel or aluminum, I think we do have to contemplate this notion that is there a scenario, or is there a market that could get so hot that would actually spook buyers completely to the sidelines? And I think it's something that Ryerson needs to be cognizant of. I think it's something steel mills need to be cognizant of. And I think it's something that our customers need to be cognizant of as they bid on projects, because, take a housing project, for example. If you were bidding on a housing project and you had a budget for that and it was set 9 months ago, all of a sudden you're probably well above your budget. Could even be millions and millions of dollars above that budget. The question becomes, does that end consumer of that product still pay for it? If they do, great news. This can continue on for a while longer. And there is a lot of money sloshing around the system. So this could continue. Now, this particular economist doesn't think that it's good news at all. And I will admit, if you look at these charts and you kind of hone in on the shaded vertical areas, those are past recessions. And you can see that, every time we see weak consumer confidence data like this, it tends to corroborate fairly closely with a recession. So, are we heading into a recession? I tend to not be of the opinion that we are. I tend to think that as I look at the landscape right now, as I see what I see within Ryerson and out amongst our community of customers, demand for now appears extremely strong. I think this is more of a frustration because demand is running so hot, but I'm open to the alternative as well. I'm open to being considerate of the alternative. I think we as risk managers, we as supply chain operators, I think we have to be thinking about that potential that there is a chance that steel prices could go so high, or automotive markets could get so tight, or housing markets could get so tight that all of a sudden buyers say, no more, I'm going to the sidelines. And who knows when they come back. If they come back in a couple months, no big deal. Prices revert a little bit back lower and they become a buyer again. But this is certainly something that it caught my eye more than anything. I don't have answers as to how it's going to play out, but it's certainly something that I think, supply chain executive committees within, manufacturing houses should be thinking about these types of things. So I'm going to breeze through some of the commodity charts very quickly, and then we'll hop into Q&A. Hopefully there's some questions, but carbon, it's upward and onward. We are now nearly double the price of Chinese steel. You can see that over the last 30 to 45 days, Chinese steel prices have actually reverted a little bit back lower, so that we're at $791 US dollars per short ton. Unfortunately, we can't buy any of that product here in the United States because we've got massive tariffs on that. But we're above $1,600 per short ton on carbon flat roll for hot roll specifically. There's still massive spreads between U.S. product or U.S. prices and foreign product, but that's not really having a factor right now. I will say though, very anecdotally, it does feel as though we're starting to get into a little bit of a transitionary period in terms of, I don't want to call peak, but I want to say something's changing within the landscape that I think more product is becoming available, and no surprise, that is corroborated within the capacity utilization data. Just in the last week, we've seen a fairly sizable uptick to the tune of about 2.5%, which if you annualize that, that'd be about 2 million tons worth of steel. I don't know if that's totally fair to do, but that's kind of how the math would work out. So something changed within the mill structure here within North America that has brought additional tons online. I don't know if that's the mills finally saying, all right, prices have gotten high enough, we can make money hand over fist, let's bring some new supply. Whatever the scenario, it's very incremental, but it does feel as though it's beginning to shift a little bit. I think enough consumers have kind of cried foul, cried uncle, that the mills are beginning to listen a little bit and provide the market with a little more metal. That being said, the futures curve hasn't changed all that much. Looking at last month in the green versus this month, the front end has shifted up a little bit just because the CRU has moved up a little bit. So the futures market has to sync up with that. But the downward slope of the curve as we look forward in time looks almost identical. So there's still an expectation, as there has been for the last 6 months, that prices are going to begin to roll over here in the not too distant future. That's at least what the futures market is saying. Admittedly, the futures market's been very wrong. You can see where it would have been 6 months ago. It was downward sloping then, but it was off by about $800. So things can change, life can come at you fast, but nonetheless, the trend is, or the expectation is that we're going to see some sort of easing in supply. And I will say anecdotally, it does kind of feel like we're in the very early stages of that transition, not just within carbon, but within some of the other metals as well. And similarly on the scrap side within carbon, very similar chart last month versus this month. So I'm not going to spend a ton of time on it, but there is an expectation we're going to reside for the balance of the year in the kind of the $600 to $700 range for scrap. I will say though, scrap being at $600 to $700 is not why steel is at $1,700 or $1,650, wherever we are. because steel mills can make money. If scrap's at $650, they can make money at $900, no problem. So there's a pretty big gap on the marginal cost of production and where ultimately steel prices are right now. So something to think about. That being said, flipping over to the aluminum side, I mentioned this idea that we're in the early stages of kind of a changing regime. It may not look like much. And again, I don't want to be here to try and call the top, but aluminum ingot prices, when you combine the LME price with the Midwest premium, are near record highs. And here within this chart, you've got the Shanghai futures price, which is in the blue, and the white line, which is the London Metal Exchange. And you can see that in both cases, there's a very tight correlation between the two of them. And both of them in the last couple of weeks have been a little peaky and been very, very choppy. Whether that's profit taking, whether that's a shifting dynamic within fundamentals, I think it could be a slight factor of both. But it seems like the easy money for those who have been on the long side or the bullish side of this market has been made, and there's been some profit taking. And we're now in a phase where, on a day-to-day basis, little changes in the news, little changes in the narrative can cause pretty swift gyrations in the price. So the market's definitely jittery. I think a lot of these commodity markets are going to be watching the employment data, the inflation data, to try and get a gauge of what interest rates are going to do, and then kind of take that as their guide for where prices should ultimately head. But certainly as we head into the summer months and we get less liquidity within the trading community, I think we're going to see some choppiness. And then I think if we continue to see inflation data outpace the way I think it might, it's going to be more and more difficult as we roll through summer to see, the Fed saying we don't want to raise rates. I think it's only a matter of time until we start to hear that narrative shift. On the Midwest premium side, only a slight shift. There's been a slight uptick in the price of premiums. We've gone from about 26 cents up to 27 on the front end, but there's still an expectation that prices come year end and into 2022 are going to be a fair amount lower. And when I say a fair amount lower, 7 or 8 cents lower than where we are today. Part of that is going to be on the back of the expectation that not only are markets, I think there's a belief that the markets are going to loosen up incrementally, but I think also there's an expectation that tariffs, particularly against Europe, may get rescinded as trade talks and as the United States creates more allegiances with the Eurozone. And then lastly, on the stainless side, I like to look at charts to try and gauge trends. And I will admit, this is one of the ugliest charts I've ever seen. You can't really make heads or tails of what the nickel market is trying to say right now. It still remains to be the case that nickel is a very well supplied commodity. Even with the EV story, even with stainless demand being extremely tight right now, I think if we were to look across all three of the metals, stainless, carbon, aluminum, the finished stainless market is admittedly the most tight. We're seeing a situation now where if you're importing metal into Canada from China, the prices we're seeing are at a premium to where domestic production numbers are. And that is not something that normally happens, but it's a sign of two things. One, it's a sign of how tight foreign markets are within stainless, but it's also a sign of, I hate to use the word desperate, but how desperate the North American economy is for more metal units, because it's not even a function of price, because normally you'd see import markets be at a discount to domestic. We're now in a scenario where that's flipped, and that only really makes sense if there's such high demand for just units that you're willing to pay whatever you can to get your hands on it. Now, if the domestic mills were smart, I think they probably play a little bit of catch up and maybe flip that back and raise prices on finished stainless. So we may see some base price increases further. But they're fairly interesting dynamic within the finished stainless world. But nickel, again, it's been very, very choppy, similar to aluminum. I still tend to believe it's a very well supplied market and doesn't need to tick substantially higher from here, but it's been choppy. It's been choppy and it's been very day to day, but not a whole lot of color to glean from this chart, unfortunately. And then we've talked about this in months prior, but price of chrome, which can sometimes cause some pretty heavy gyrations within the stainless surcharge. It's recovered very slightly from last month, but comparing quarter over quarter prices as we try and forecast where Q3 chrome resets are going to be, it looks like there's going to be a fairly heavy reset lower given where chrome prices are. So assuming there's nothing drastic that happens within South Africa, it very much so looks that as we roll through into the mid and late summer, we should see the chrome element of stainless surcharges actually retreat a little bit. So Jason, I think you were the one that gave me this this one, but ultimately it's the chrome lining to stainless.
Yeah.
That while everything else within the stainless world's going up, chrome's the one thing that's offering a little bit of bastion of safety, if you will. But that being said, that's what we've got on the commodity and the macro landscape for this month. Again, I think the overarching theme is that ever so slightly, some of the markets are loosening up. Not all of them. It's becoming a little more commodity to commodity, but I think we're beginning that transition. I think the employment picture is beginning to evolve. I think that's going to hopefully start to loosen up. We'll see that hopefully in the data tomorrow, and then we'll see. I don't know if the prediction on crude oil end up playing out or not, but I still think even if crude oil doesn't end up rallying, the inflation story is alive and well. And I personally think it's going to be a matter of time until we start to see interest rates tick up to try and cool some of these things.
For sure. Yeah, we've got a few questions pop in. And while I'm going over these, I know one of them was a comment on used cars. I know we talked yesterday about price of used cars and how much they've increased. If you want to tell that anecdote.
Yeah, sure. I mean, a couple quick things about that. One is when you look at the CPI data that came in last month, that shocked everybody somehow. I don't know why it shocked everybody so substantially, because the price of pretty much everything's at record highs. But that being said, the used automotive market is no different. And I'll give a couple anecdotes on that. But within that CPI data, the reason why I brought that up is because the vast majority of the CPI uptick on a month-over-month basis was really driven by the used car market, which is kind of interesting that such a small piece of the overall index that is the CPI, the Consumer Price Index, was made up of this drastic change or increase in the price of used cars. I think that trend is continuing, though. I actually spoke with a customer, and this is anecdotal, but I spoke with a customer 3-4 days ago, and he indicated that I think it should be fine that I'm sharing the story because I think it's pervasive across the country. He indicated that he bought a Ford F-150 for like $26,000. It was a used Ford F-150. He bought it back in February of 2020. And he indicated that over the last several weeks, he's been getting calls every single week from the dealership saying, we want to buy it back and we'll pay you a premium for it. And he said, don't you know that I drove it this entire year? And they said, we don't care. We will pay you more for the vehicle. And they're willing to pay him in the low 30s for this vehicle that he bought for several $1,000s less than that, which, you know, in an automotive market with a depreciating asset, that doesn't make a ton of sense until you consider the fact that the new car market is struggling right now. So there's a shortage of cars. There's tons of cash around the economy, and the semiconductor issue has reared its ugly head within new car data. We saw that just yesterday within the Ward's automotive data. It missed expectations. I think it came in at like 16.9 million units. The prior month was 18.5. So I think that's going to be relatively short-lived. I think it's a matter of time until those semiconductor issues are figured out. But it's certainly not helping the used car market that new cars aren't being produced as well, because that just tightens up supply.
Right. Yep. Crazy. So here's one. Is there a possible delivery issue in June for domestic mills due to overbookings, labor shortages, or price increases? Could this affect July, or is June the bottom of this issue?
Without knowing the specific market or metal that they're talking about, it's possible. I mean, I think in all instances, whether we're talking about stainless, aluminum, or carbon, mills are already backed up. So we're already in a situation where they're missing orders to a degree, but you know, obviously as we roll through time, they continue to deliver. I think depending on the market, their ability to catch up is slightly different depending on the market. Stainless is still crazy tight. I think carbon is in the very early stages of getting a little better, and maybe aluminum is actually in the early stages of getting better as well. But in terms of running out, it's a bit of a more difficult question. You know, in terms of Ryerson and this is kind of a shameless plug, but within Ryerson and our own customer base, we're going to do everything we can to ensure that the tons that we've promised, we're going to be able to allocate to our customers because we've got those contracts negotiated with our supplying mills. Is it possible that other service centers might run out of materials? For sure. If they position themselves in a bearish fashion, they wanted to lean up on inventories at the wrong time, it's absolutely possible. But from the mill side and Ryerson specifically, I don't think that's going to be a massive issue. It's tight though. The market's definitely tight.
Right. Another industry analyst has been predicting a steep drop in HRC prices in Q3, that they recede back to $600 to $700 by the end of the year. What do you think?
I know who some of those analysts are. I admittedly would have been in the camp of saying that prices needed to recover, needed to revert back lower very quickly as well. And I would have been in that boat for the last 6 months, and we've continued to tick higher. So, shame on me. I've been very wrong throughout the course of this upswing as well. I will counter that slightly by saying what goes up must come down. The steel industry tends to overswing to the upside and overswing to the downside. I do have concerns. It does definitely keep me up at night knowing that the marginal cost of production is at $900 $950 a ton, even with scrap near record highs. The reason why that's scary to me is because there's really nothing fundamental between $1,650 for hot roll and that $900 $950 cost of production that says why we should be at one level versus another. If demand were to go to the sidelines for a couple months, yeah, it would concern me that the air could get pulled out of this market in a very quick fashion. We are not seeing that yet. We are still seeing demand very much so fruitful and maintaining to the orders that they've committed to us. That may be specific to Ryerson, but the analysts out there who are saying $600 to $700, I would say it's almost a virtual impossibility given where scrap prices are, because no mill is going to sell below their cost of scrap. So I don't see 600 to 700 playing out. Could I see a big drop in steel prices between now and year end? Yeah, I could. I definitely could. Could I see us maintaining the current price level for the balance of the year? Yeah, I could. And I've admittedly been wrong and undershot how strong demand has been. I mean, I know we touched on the PMI data on the first slide, but I mean, ISM manufacturing is running at 62. Many other regions of the world are running mid 50s to 60s. ISM services is at the highest level in history. The end demand, the end consumer is feeling good right now. That can change, and nothing changes sentiment like price, but we're not seeing it yet.
Yep. Okay. I know, Nick, you and I have talked about this, but a question on carbon steel: is more capacity coming online soon?
Yes. So we're already seeing it domestically with regards to the existing mills, where we saw production capacity go from 79 last week to 81.5 this week. I think that's a very encouraging sign for the market to get back to a more balanced state. I don't know if that's a function of just service centers and end users bashing the table, threatening to go to DC. I'm not sure what caused that change of heart, but you can see that it's a pretty swift uptick in the, I'll just flip back to it real quick. There's definitely a change of operations within the trajectory of that recovery. So again, I don't have full clarity into why that's improved the way it has, except for the fact that there's a ton of money to be made. And for any of these profit generating entities, I'd be running the mills full bore right now if I could. That's just me personally. But in addition to that, we've got Steel Dynamics coming online. They're going to be committing to orders in August, I believe, of this year. So Sinton is going to be coming online. AMSA in Mexico is going to be coming online. And there are two more mills that are going to be bringing, and this is new production capacity, come Q4 is the expectation. And in total, those four mills, they equate to 11 million tons of incremental annualized capacity. So that's almost 15% of new production capacity that's expected to come online. Now, that's not magically going to fix the market, but every little bit's going to help.
Okay. What is the trend for scrap metal pricing? I know you've got a chart on that, but
I mean, I think the futures curve is about the best guess that we have right now. I do think that if we started to see finished steel prices move lower, scrap would probably go with it, because right now every scrap yard knows where the price of steel is, so they're not feeling overly pressured to compete for pricing right now. So they're fine selling metal wherever they want. It's kind of take it or leave it for the mills, because the mills can flip that around and sell steel for $1,600-$1,700. But that being said, I think that, there's definitely more incremental demand for scrap. We've talked about this in months prior. Electric arc furnaces are the way of the future. They're more nimble, they're more flexible, they're more green, they're cheaper to operate. They've got easier restart costs to flip on and off. So yeah, I think there could be an argument that as we roll through time over the next 2, 3, 4 years, there's just a greater general demand for scrap. Maybe that resets the scrap floor somewhere in the realm of $400 or $500, maybe $600. If that's the case, yeah, maybe you could say that resets the steel floor. But for the balance of the year, the scrap market looks tight. And I think the more and more we see this narrative push towards green energy and reducing carbon footprints, I think scrap is going to look like a more and more attractive asset.
Okay. Let's see. We're getting a lot of questions today. This is great. Can you update us on mill capacity utilization? Has this improved in the last month?
Well, we kind of touched on that. I'll answer this one quickly. It has. We talked about it at length a few slides ago, but it looks like it's something in the last week has, I don't want to say dramatically, but it's definitely shifted a bit. Capacity utilization is coming back online for
sure. For U.S. mills, how long is the backlog and U.S. strike impact going to affect the current lead time and pricing for domestic materials before the balance from the U.S. mills level again?
Yeah, I mean, if we're talking lead times, I'd say probably, I don't know what the published lead times are. It depends mill to mill, but you're talking probably 10 to 12 weeks, maybe slightly longer on more specialized products, but they're extended. They're very extended. You're normally in a balanced market, you'd see these being 4 to 5 weeks,
right?
Maybe less. So they're more than double that, I'd say.
I don't know anything about this, but have you heard anything about steel mills with maintenance, shutdowns, like summertime shutdowns and normal? Are they gonna?
Yeah, there are some that are announced. I mean, I think over the course of the summer, I think there's a chance that many of those normal OEM shutdowns due to the automotive industry changing out dies, refreshing for new years. All of those things may be slightly flipped on their head to a degree, because right now the automotive industry has bigger issues with just trying to get caught up from a semiconductor standpoint. Yeah, there are going to be periodic outages though, but I don't think they're going to massively move the needle one way or the other. We've seen outages over the last couple of months as well, but I kind of discount those a little bit, to be honest.
Yeah. Okay. Can you show the steel future slide one more time?
Absolutely.
Yeah, and just so everyone knows, we'll have this on our YouTube channel. You can watch later. Send it to your friends and family. So check that out. That should be posted sometime next week when Mike gets back from vacation. You mentioned about massive tariff from steel in China. What are the current tariffs in place?
They range in a pretty broad fashion on carbon steel, but I mean, I guess they can be anywhere from 300% to 500% depending on the grade and the product. But it for the United States, it makes touching carbon steel from China virtually impossible, because if you're applying a 300% to 500% tariff on top of something that's $700, it makes it uncompetitive pretty immediately. So, but it's massive. And my personal opinion is, I don't think the tariffs on China are going anywhere. I think there's a chance we could see them come down on many other regions of the world, but I think all of the tariffs all along, whether it was under Obama, whether it was under Trump or Biden, they've always been centered around the overproduction issues with regards to China.
So this is a long one. So I got a long one here, but I'm going to try to paraphrase. So mills, are they picking and choosing grades and tons available for certain, grades for production? I know we're not on allocation in a lot of cases, but I'm assuming some of that has to do with that.
Yeah, are they picking and choosing? I would say, yeah, probably. Yeah, I mean, if they're, and let me disclaim this answer by saying I'm not the one who actually interfaces with the mills, so I'm not the one who's actually entering into these contracts. But I think just thinking out loud, if you were constrained with production and you're trying to find the best place to make as much money as you can, I would say absolutely you are going to pick your spots where you can, supply the market that's going to provide the best margins, or that's in the most demand where you can then sell it for the best price. So yeah, I think for sure there are going to be certain products, certain grades that are going to warrant more interest from the steel mills. And we see that within aluminum as well, where sometimes they'll just say, we don't want to produce for this market anymore because we don't do it profitably. So yeah, I think those sorts of things definitely happen. They can happen intermittently throughout the year. They can happen over longer periods of time as well.
Yeah. With SSAB, Algoma, and other mills going to planned shutdowns, do you foresee things getting tighter in the short term?
And it's hard to imagine it's getting much tighter than right now. I mean, prices are name your price still. If anything, I think the market's ever so slightly loosening up. I don't think those planned shutdowns are massive needle movers. I think they might help, and they tend to get a lot of traction anecdotally within the marketplace. But if they're out for 2-3 weeks for a maintenance shutdown, I don't think that's going to move the needle too much personally. Now that's again just my own personal opinion.
Yeah, and I think that's usually built into the lead time in most cases, right? So if they know when things are coming up, yeah. How is transportation cost affecting the overall market?
Massively. Within North America, I referenced the flatbed truck rate. That the flatbed truck index is slightly coming off of its peak, which is basically an all-time high. But it's still very elevated. So that's a tight market. Obviously, the fact that everything's moved to online shipments as people have been home for the last year and gotten used to that sort of shipping mechanism, it's raised the demand for flatbed trucks and truck shipments in general. But outside of North America, and admittedly things are tight within North America as well, but outside of North America, I would say it's getting worse. We're actually seeing freight rates that are impacting shipments from China, from Taiwan, places like that are 45 cents. They're adding 35 to 45 cents per pound in certain products onto the price of metal. And interestingly enough, I mean, China's still having issues with COVID at their ports, and it's not at every region, but at certain spots, we're hearing that they're actually having COVID outbreaks, and they may not be large numbers of cases, but they're enough that it's impacting ports and shipments, and that's not helping the freight rates at all or the containerized rates at all. So yeah, the international market's still really ugly and maybe even getting worse. I think maybe we're in the worst or maybe coming through the worst here within North America.
Yeah. Okay. Any insight on the 232 on stainless being dropped from the EU and Japan?
It's just personal opinion based on what I'm reading. I think there's absolutely an olive branch being extended from the EU. I think if the EU is able to successfully, get 232 tariffs rescinded, I think there will be other ally-related nations that will try and do the same. I wouldn't be surprised if they get pulled back within Europe and within some of the other allied nations. When does that happen? Your guess is as good as mine. I unfortunately don't have the answer to that one, but there are certainly efforts that are being taken that are very public within the EU where they're trying to set the stage for a more cooperative trade environment within the EU. And I think that's growing more and more important as trade relations with China and potentially arguably Russia are not going the right direction.
Okay. Has there been any talk about the impact of an infrastructure bill and what that would do to the impact on the U.S. market?
We talked about it in months prior.
Yeah.
It's a moving target because even today we got some more data that says that Biden may be willing to settle on a $1 trillion package, and with that $1 trillion package, there wouldn't be any need to increase corporate taxes. That's just kind of a new stance. So, I would love to comment on it, but it's shifting around by trillions of dollars depending on the day you wake up, and the way it's structured is difficult. But I mean, all I can really say is the market right now is incredibly tight already, and if we add more money into the system, I'm not sure where it ultimately goes in the short term. Now, again, the infrastructure bill is an 8 to 10 year project, so ultimately I expect things to loosen up and things will normalize, and we'll be able to handle all this. But yeah, I mean, I don't. My personal take is what the economy doesn't need right now is more money. I think if anything, we just need to get people back to working in the places where they're supposed to work and more efficiently. And I think that will ultimately come both within North America and globally as we get vaccinated and get people comfortable again. I don't think adding more money either via unemployment benefits or just as stimulus into the economy, I don't think that's really what we're missing out on right now. I think we've got plenty sloshing around right now.
Right. What's your insight on copper prices?
I'd say similar to aluminum and nickel. I think they're all following the same general theme. Copper prices are at record highs. There have been some write-ups in the last month or two that kind of says copper is the new crude oil because it's so necessary in electronic components. I think that's absolutely fair. But like all markets, it's an industrial metal as well. And if we start to see interest rates tick up and potentially have some cold water thrown on it by way of China or something like that, copper is going to go the same way aluminum and nickel are. So I would say a lot of my commentary that I gave on nickel and aluminum, which is that we're starting to see some frothiness, some profit taking, some choppiness. We're seeing that within copper as well.
Okay. And then one more, how much weight do you put on money supply as a driver of dollars to feed into the higher prices of industrial commodities globally?
A lot, a lot. Yeah. I mean, I think, you had $6 trillion here within the United States. You've got trillions of dollars added globally. That added supply weakens the currency, which ultimately causes fears of inflation. All these things are interrelated, but I think without a doubt, the added money supply has fed into creating this situation. But that's not to say it's a bad thing necessarily. I think a lot of it was purposeful. I think from the viewpoint of DC and a lot of other administrations around the world, the viewpoint was we shut this thing down artificially. We need to jumpstart it artificially. And I think with an economy as big as ours, 18 to $20 trillion GDP economy, it takes a lot of dollars to jumpstart the engine again. And we've seen that. Now, we could debate whether or not we've added too much or too little from here. I've got opinions, but yeah, I think there's definitely a relationship between the amount of money flowing around and ultimately where asset prices go. And I don't think it's just in metals. I think look at home prices, look at used car markets. I mean, look at AMC being valued at $30 billion today. I mean, I feel like every single time we come on a Cup of Joe, we've got another funny bubble going on, whether it's Dogecoin or AMC or it's just flavor of the day. But it's a lot of money flowing around trying to find a home.
Sure.
And I think one of the places where that can flow is into metals.
Right. I mean, yeah, anything you're shopping for, you're going to have a hard time to find it. And if you do, you're going to pay more for it.
That's right.
That's it.
Yeah.
All right. Well, that is all the questions. Thanks everyone for joining us this afternoon for Cup of Joe. Glad you can make it again. This will be on YouTube. So check us out there. And we appreciate your time. Thanks everybody. We'll see you again next month. Cup of Joe.